Well, aloha, folks. It's your boy here, Jason C. Scott with Task Force Mortgage Team, powered by Cross Country Mortgage. And today, I'm going to teach you the sweep strategy. Yes, you heard that correctly. It's called a sweep strategy because you're going to sweep all that high mortgage interest away, and you're going to pay off your 30-year mortgage in 8.5 years. Details to follow. You're definitely going to want to tune in for this. Well, aloha, folks. It's Jason again, and there we are. Now I'm on. Beautiful. Okay, so like I said at the beginning of the video, I'm going to teach you something absolutely for free that a lot of people will pay thousands of dollars to go to a seminar to learn a very simple tactic, right? So this is called the sweep strategy. And basically what we're going to do is we're going to use a purchase of a $500,000 home at a current interest rate of 5.125%. And if their repayment date started today, September 13th. Okay. Now, traditionally, the way people pay bills is, you've got your income coming in, it goes into a checking account. Then they pay their mortgages and their bills and all that other stuff, right? Well, with the sweep strategy, what you're doing is you're actually leveraging your HELOC to do all this. So in this very simple presentation, I'm going to show you someone that has an income of coming in of about $10K a month, and they have a total monthly debt load of $7,500. And that's to include basically the mortgage payment at the minimum, what it would cost to repay a payment on the HELOC, and then also any additional discretionary. It's very important that when you create your monthly budget, you factor in there how much you would need outside of just paying bills, but for going to the movies or going out to dinner, stuff like that. You actually want a holistic, real budget, so that way every dollar is accounted for. Okay. So in this scenario, basically what would happen is the first payment, you're actually going to take a $10,000 draw on your HELOC and apply that directly towards the principal on your mortgage payment. And you're going to use your normal income to pay your normal bills of $7,500. That's month one. Month two, your $10,000 income comes in, it goes directly into the HELOC account, right? When you put it into the HELOC account, technically that would pay off the $10,000 that you just borrowed, but you're going to do a $7,500 draw to make your normal bills, right? You're going to live off that $7,500, which then now leaves a balance of $2,500 in your HELOC account, right? That's month two. Month three, $10,000 comes in, you deposit the $10K into your account, right? It pays off the actual $2,500, but you still have $7,500 left over to pay all your bills, right? And your HELOC is at a zero balance. Month four, you're going to have your income, pay your $7,500 in bills, but then you're going to take out another $10K in the HELOC and apply it towards the principal. And we're going to literally rinse, lather, and repeat. And you're going to do this literally for 102 months, which, in case you were wondering what 102 months is, that's 8.5 years. Now, I want to show you what this looks like. Come on. There we go. Amortization schedule. So, $500,000 loan. That's your technically principal and interest payment, right? At 5.125. So like we said, that first one, $10,000 goes in right towards the principal. You make your normal payment, like I said, and then rinse, lather, repeat. And you can see it all the way down here. And as you continue to do this right around gotta go back up here. Out of that payment, out of that $2,700, every time you make this $10,000, it readjusts the amortization schedule to where you have more going towards principal than you do interest, right? And just by doing that, at 102 months, that's your freedom point. That's what you have left on the actual mortgage, right? So when you figure your regular payment $2,700, your total payment only is only $1,093. You have that much going to principal, that much going to interest. And at 8.5 years, you've only had to pay $116,000 in interest compared to 30 years where you'll pay literally almost $1 million in interest, right? Now, the next cool trick is, what does that look like appreciation-wise? So let's move this out of the way. So now that you paid off your home in 8.5 years, so let's just bump this to 9 years. In 9 years, that $500,000 purchase, now granted, this scenario is for Colorado Springs, but it doesn't matter what market, we can adjust the appreciation value for your market. Look at what the home value is worth. Crazy, right? You've paid off your home in under 9 years, and in 9 years, if you were to live in this zip code, which is where I live, you have an equity gain of $268,000. So now your home's worth $768,000 and you don't have a mortgage payment. That's a sweep strategy literally in about 5 minutes or less. And I didn't have to charge you, thousands of dollars to go listen for an hour and a half and give you cookies and water and stuff. So if you have questions and you want to see if this works for you, just reach out to me or leave a comment down below, and I'll be more than happy to help. Other than that, make it a great day and aloha.